next week's Fed decision as investors search for any clues into the path for interest rate cuts.
Concerns are now growing over whether the central bank will have to keep rates higher or longer. The Federal Reserve wraps up its two-day interest rate setting meeting. So
if you want to understand how to use fundamentals to trade stocks, Forex, futures, and commodities, the most important thing you need to learn is how to predict the direction of interest rates from central banks like the Federal Reserve. It's easier than you think. Hello everyone, I'm Kathy Lee with BK Traders. Many traders wonder how the experts calculate the percentage chance of an interest rate cut by a central bank. Do they make it up? Do they find it somewhere? Most of you know how important this information is because it can determine the direction of stocks, currencies, gold, and oil. But you may have no idea where the number comes from. In this video, we're diving deep into the world of interest rates because it's so important. I will explain to you exactly how the experts determine the likelihood of interest rate changes by central banks and the math behind their calculations. Whether you're a seasoned trader or just getting started, understanding how interest rate changes are calculated can give you a significant edge in the market because other markets are not always pricing in the same expectations as interest rate futures. And interest rate futures can oftentimes give you a guide to where other instruments are headed. The greater the chance of a Federal Reserve interest rate cut, for example, the better it is for stocks and the worse it is for the US dollar. And the greater the chance of a rate hike, the worse it is for stocks and the better it is for the US dollar. That's a rule of thumb. So strap in, and if you haven't done so already, make sure to subscribe to our channel and hit the bell icon. This way you'll receive notifications every time I post valuable trading content. Now let's get started. In this article for Bloomberg, it says, the first interest rate cut from the Federal Reserve is now fully priced in by December, according to the swaps market. The odds of a second reduction stands at 30%, compared to 70% last week. How did they come up with these numbers? It's actually quite simple, and you can find the information in seconds because traders sitting in their pajamas in their basement have the same information at their fingertips in real time as the reporters in Bloomberg's fancy New York headquarters with that curved escalator. These numbers are derived from what we call Fed Fund futures, which are traded on the Chicago Mercantile Exchange, the CME, and they represent the market's expectations of the average daily forecast for the Fed funds rate, or the interest rate that banks lend to each other overnight. Now, the CME actually does all of the work for you and for all of those high-paying reporters and economists by publishing the information on the website. And I've included the link in the description below, so check it out there. This is their CME Fed Watch tool. Everyone from journalists to economists, hedge funds, and bank traders get this information from the same place. It's super easy to find with a quick Google search. Let's try. Let's type in CME Fed Watch tool. So you click on this link, you get the CME Fed Watch tool. And there's a lot of information here. These tabs are the upcoming meetings. So in this case, the next meeting's on June 12th. And then the following meetings on July 31st, September, November, and December. So you can see here right now that the meeting date is June 12th, and the Fed Fund futures rate is 94.6725. And based upon this, the CME has done the work for you, and they calculate that there's a 98.9% chance that the Federal Reserve will leave interest rates unchanged at the July meeting. And this is what the market is pricing in. Now, down here, you can see how this changes. One day ago, not much change, but 1 month ago, there was a 90% chance. Now, this is still very high chances, but as we go through July, for example, here we have a 87% chance that rates will remain unchanged. And a month ago, that was sitting at 77%. So the market is not really, in this case, at this time, pricing in a realistic chance of a interest rate cut by the Federal Reserve until September. Because in September, you have 46.5 plus 5.6, which is basically a 52% chance of a 25 basis point cut. The market's pricing in a 52% chance that there will be a 25 basis point cut in September. And we calculate that by 100 minus 94.75 in this case. And you can also see how this changes because 1 month ago, the market was pricing in, I guess not too much difference. The market was pricing in about 46% chance. So if you fast forward to the last contract of the year, December, you could see the market's pricing in 40% plus 32 plus 10. So that's basically 72, 82, about 85% chance of one interest rate cut by December. But this was very different a month ago. If you look at the lower right-hand corner, in the lower right-hand corner, you can see that it was 40 plus 23 plus 7. So basically a 73% chance. And this will always change with time. But this is where you get the information. The CME does the work for you, and they show you the percentages already. Now, the price of a Fed fund future is quoted as 100 minus the implied Federal Reserve funds rate. For example, if the price of the future is 94.50, the applied rate is 100 minus 94.50, or 5.5%. To calculate the probability of rate hikes, you need to look at the difference between the current month's future price versus the next month's price. And that calculation gives you the probability of a rate cut or a rate hike. Thankfully, you don't need to run the math yourself because the CME does it all for you and tells you exactly what is priced in, like 89%, for example, of no change in interest rates in July that you can see here. But knowing how to calculate the probability is important if you want to know what's priced in for other countries, because not everyone does the work for you like the CME. If you trade the euro, you want to understand how the experts determine how likely the European Central Bank is to lower or raise interest rates. What you'll need to look at is Euribor futures. Euribor futures are standardized contracts that represent the market's expectations of future interest rate changes for euro-denominated deposits. These contracts are traded on exchanges like the Eurex. The price of Euribor futures is quoted in the same way as the Fed fund futures, which is 100 minus the implied 3-month Euribor rate. Now, you can turn to trusty Google to get your current Euribor rate and Google it, or you can actually go to your TradingView charts, which I think most of you have. So on your TradingView chart, what you want to do is you want to type in Euribor. And you'll see Euribor 3-month rate, and it's here at 96.25. And so the calculation would be 100 minus 96.25. To determine the ECB's rate change expectations, you need to compare the futures contract for the months around the ECB meetings. For the UK, we use the Sterling Overnight Index Average, or SONIA, which is the risk-free rate for sterling markets. Once again, you can Google it, or you can search for the rate on your TradingView charts. Just type in SONIA, and you can see that the 3-month rate is 100 minus 94.76, which is basically 0.25, which means that quarter-point cut is priced in for the UK. Now, of course, the calculations can get more complicated. Experts like to dive deep by looking at the implied forward rates, but that really involves more math than most of us are interested in or really need to do, quite frankly. So, what can you do with this information? That's more important. The first thing is to know that these contracts, the Fed funds rate, Euribor rate, SONIA, move constantly, which means interest rate expectations change all of the time. They can go from pricing in 4 rate cuts at the beginning of the year to just 1. Staying ahead of these changes are very important because interest rate expectations will oftentimes lead other markets. They change first, and they lead other markets like stocks, Forex, gold. So if you are traders in those markets, they can be a leading indicator because oftentimes traders in those markets are more skeptical about what's going to happen, and they react a little bit later. That is why it is so important to take cue from interest rate expectations. I hope you found this video valuable and you got a better understanding of how the experts get this number of what's the percent of interest rate cut or hikes for the year and the odds, and the way that it's determined. Knowing the market's expectation can help you position your trade to capitalize on anticipated rate changes. Whether it's adjusting your positions in stocks, Forex, or gold and other assets, having this insight is invaluable. Don't forget to like, comment, and subscribe for more trading tips and fundamental strategies. Thank you for watching. I will see you all next time.